Well, we're really looking forward to this next 90 minutes together. So I guess we'll start with some quick introductions. We did call out Vivek and Andrew and Chamath and your roles as co-founder of Clover Health and founder, CEO of Social Capital, and Chief Technology Officer, President and Board Director of Clover Health. And you're stuck with Bill and I. We don't really have any great titles to offer. We haven't really gotten out there in the awesome ways that you all have, but we're really excited to talk about SPACs, Clover Health, and investing in general. And I think the best opening question for everyone out here today is just a quick definition of a SPAC. Probably we all know it by now, but obviously it's an exciting development so much in the last year. So definition of SPAC and how it's different, better, or more special than IPOs.
Yeah, I mean, I guess I can take that. A SPAC is a special purpose acquisition company. So what is it? It's basically a group of people. The leader of that group of people is called the sponsor. But so in my case, it's myself, and I have a handful of partners that I consistently work with in these things. And we file an S1 and go through a traditional IPO process, except that what we are describing in the S1 is essentially a company that has one asset, just money. It doesn't make a product. It doesn't sell anything. And then the purpose of that vehicle is in the business of finding another company to acquire. And so, whereas Google's S1 would have described a search engine in the business of acquiring users and, providing them relevant information, et cetera, ours is a shell company, a balance sheet of cash, which we then use to go and find a business that we think is really compelling and interesting. And we can describe that interest on many dimensions. It could be geographical. It could be about a specific vertical. And then we go and we buy that company. And when we do that, it's effectively a merger. And so for the company that we acquire, they go public by being acquired by us. And what it does is that it allows them to actually write an S4 document together. And by writing an S4 versus an S1, we are covered under a different body of law, securities law, that's enforceable by the SEC. And the major differences there for the purposes of the viewers and the listeners is essentially that it allows you to talk about the future. And the reason why I think that single thing is such an important feature for SPACs and why SPACs are a really important part of building a modern portfolio is that in a world of zero rates, I would sort of put out there that everything is about the future. And that you need to be really understanding the potential of a company's performance in 2023, 25, 27, 29, 2030 even. And that those future cash flows, especially for technology companies, are very poorly described by looking at the past. So 2016 through 2019 don't really mean much for 2025's earnings. That's not true for other businesses, but it is very true for tech businesses. And so the S4 process allows Vivek and Andrew, myself, the ability to really understand the business, underwrite the future for many years out, and then have a conversation with people who may potentially be interested in buying it about describing that future performance and then give folks the chance to buy. There's a bunch of other sort of secondary features that I think a SPAC gives. It allows retail much better access to growth and growth investments than traditional IPOs do. It provides certainty of price. So I think there's a lot of other things that it gives you, but the first thing that I described, bringing forward a shell and then acquiring a business so that you can talk about that business's future prospects is probably the single distinguishing feature that I think matters.
Is there a situation that you can think of where an IPO is a better process than a SPAC at this point?
Absolutely. I think that there are three, legs of a capital market stool now for liquidity. There's the traditional IPO, there is the direct listing process, and there is a SPAC process. Last year, I went through both the direct listing. I was the Series A investor in Slack. We listed through a direct listing, and I bought Virgin Galactic and brought that company public via SPAC. What I would tell you is that the IPO is incredibly powerful for businesses whose cash flow characteristics are relatively predictable, last year, today, to next year. And frankly, more importantly, who probably are better off being judged by the past than on being forced to produce a forecast and be talking about the future. And I think that there are many companies for whom that process then, sort of is probably the best. And there are many companies in private equity portfolios that probably fall into that category. I think the direct listing is really good for a company that has a really great brand, and whether it's institutional buy-side investors or retail who identify with that brand and would want to be associated with it. Spotify and Slack are great examples. Recently, Palantir and Asana are others. And I think there could be many more over time. But the key thing there, now there's some rumblings that it could change, but the key feature there is that you don't really need any money. You're not trying to raise any capital. You're just kind of listing the shares. And then I think the direct listing, though, is just pales in comparison, and the IPO pales in comparison to the SPAC, which is singularly the best for any company whose best growth is ahead of them.
Yeah, I was going to ask if you thought that it might change. The SEC is talking about allowing companies to raise capital along with the original listing of the security. Do you think that would change the calculus a little bit? Not necessarily for you, but for people who are going into the public markets in general?
I think actually what it's going to do is it's going to exacerbate the principal agent dilemma and a conflict that exists in the public markets. I think what we have is the beginnings of the rebels, storming the compound. We have an entrenched orthodoxy of people that have helped keep other rich people rich for a really long time. If you want to talk about what's really exacerbated the inequality gap, it's been that. I don't think it's necessarily that Mark Zuckerberg shouldn't have been rich. I think it's just that the return stream that is available to normal, ordinary folks is just not the same as if you're a qualified investor, or if you have a foundation or access to hedge funds. If you're part of the entrenched aristocracy, and underneath that is a massive principal agent conflict. And I think the IPOs are riddled with them, and I think the direct listings are riddled with them. Because fundamentally what you're not having is an individual or group of individuals who are personally underwriting an outcome with their own capital. What you have are people who want to optimize for velocity of transaction. And the minute that happens and you're taxing and you make the same money no matter the outcome, you're going to have a whole bunch of crappy outcomes. Or the best outcomes are only going to go to the favored few, where the banks have, for example, great prime brokerage relationships where they're making hundreds of millions of them on trading fees and margin and other things. Those are their real customers. So I think it's just going to further shine a light on the principal agent conflict that exists in the capital markets and how it entrenches returns to the few. Whereas I think what SPACs do, at least some, when they're executed correctly, breaks the principal agent conflict, creates an access to return stream that otherwise wouldn't be available to, ordinary normal folks, and starts to make the principal agent conflict more balanced and tilts it more towards the principals.